In this week's video, we'll review historical and present-day data to help us answer the question, is the stock market about to complete the riskiest triple top of all time? We'll start with an incredibly powerful concept that will carry through the entire video this week. The most basic laws in economics are the law of supply and the law of demand. Indeed, almost every economic event or phenomenon is the product of the interaction of these two laws. If you want to understand the financial markets and the economy, there is no better place to start than this concept on the screen. One of the most important questions that investors have been asking themselves in recent weeks is the following. If the Fed decides to cut rates, will it be effective relative to the economy, and more importantly, from our perspective, the stock market? Let's revisit this topic and update the results using the following concept. If we want to know what the weather is like outside, one of the best ways to do that is to simply look out the window. January 4th, 2019, we get friendly comments from the Fed, the stock market surges. Thus, it's very, very difficult in January of this year to make the argument that we're on the right side of this curve here, as covered on Friday, June 7th. Additional friendly comments from the Fed on Tuesday morning, June 4th. And once again, the S&P 500 reacts in an extremely positive manner. 2 weeks ago, we had the extremely weak and disappointing employment report, and the market started to believe that it's possible that the Fed could cut 3 times before the end of the year, given the fact that the S&P 500 was up over 1% on Friday, June 7th. Once again, very, very difficult to make the argument that the Fed is on this side of the curve. Very, very easy to make the argument that we should expect Fed policy to be effective relative to the stock market until proven otherwise. Let's fast forward to this week, June 19th. Federal Reserve expresses concern about U.S. economy and signals interest rate cuts are likely. What type of feedback did we get relative to the curve from the equity markets? Once again, very, very favorable. Monday through Thursday this week, the S&P was up over 2%. Very difficult to make the argument that we're in the ineffective part of this curve. Very, very easy to continue to make the argument that Fed policy relative to the stock market has been and continues to be effective until proven otherwise. Like everything else, we'll continue to take this topic day by day. And from a historical perspective, not particularly surprising that the markets have acted in a favorable manner in the wake of last week's analysis, which told us historically, when the economy was not in a recession and the Fed cuts for the first time, good things tend to happen in the stock market. You can find that video by Googling this title here where my cursor is. And after performing some new studies this week, the million-dollar question is, are cracks starting to appear in this type of analysis? The concept of market participants reaching a bull-bear tipping point can also be applied to the credit markets and credit spreads, which helps us better understand this simple fact. The Fed has somewhat of a limited control over interest rates, the credit markets, and thus credit spreads. They can influence rates, they can influence the credit markets, and they can influence spreads, but they cannot control them. If the Fed decides to lower interest rates next month in July, as is widely anticipated by market participants, they will not simply send out a memo and say we're lowering rates. The law of supply and the law of demand come into play via open market operations. When the Fed wants to lower rates or take on an expansionary policy, they basically ask the primary dealers Do you have some customers here, market participants out here that might want to sell their bonds? A client of one of these firms may say, yes, I'll put my bond out to bid. The client accepts the bid. The bond goes over to the asset side of the Fed's balance sheet, and the Fed injects liquidity or cash into the system via the primary dealers. Some of these transactions take place between the Fed and the primary dealers. In some instances, the dealers act as dealers, just go-betweens between individuals, businesses, and banks. And thus, there are instances where the liquidity is injected into the system. But once the cash gets to this point, the Fed starts to have a somewhat limited impact on the credit markets. When market participants believe that future economic outcomes are still favorable and that we will most likely avoid a recession, many of them will seek higher yields in the form of JNK or HYG in the ETF world, because in a favorable economic environment, default risk is relatively low relative to an unfavorable economic environment. Just as a bull-bear tipping point is reached relative to Fed policy and the stock market, a bull-bear tipping point is also reached in the credit markets, where it's no longer attractive for market participants to seek the higher yield. They would prefer to protect their principal and take a lower yield, maybe in the form of a TLT, long-term treasury bonds, or IEF. Both, in terms of the individual securities inside of these ETFs' portfolio, are backed by the full faith and credit of the U.S. government. Really doesn't do me much good to buy a bond that's paying 15% if 6 months later the company goes into bankruptcy. It's possible I could lose all of my principal, or I could only get back a percentage of my original principal. Thus, once the Fed injects the liquidity into the system, it's market participants that ultimately control the fate of credit spreads. If an individual, a business, or a bank is more confident about the economy and they feel that default rates will remain relatively low, they're willing to accept that risk for the higher yield in a JNK or HYG. But at some point, that bull-bear tipping point is reached where they're concerned about future economic outcomes and concerned about rising default rates, and they may decide, regardless of what the Fed is doing over here, to invest those funds into a lower yielding and safer investment in the ETF world. That might be IEF, intermediate treasuries, or long-term treasuries, TLT. So hypothetically, if JNK is yielding 6% on an annual basis and IEF is yielding 2%, that's where our credit spread comes from. The 4% spread is the additional yield that you get for taking on the higher risk. When this confidence starts to erode relative to market participants, relative demand for these securities drops, and when we sell bonds, interest rates or yields rise, or if we were trying to issue a new bond, we would have to compensate investors for the higher risk by paying a higher yield. Hence, how credit spreads widen when confidence gets on the right side of the bull-bear tipping point. And that's how spreads can move from a somewhat comfortable 4% level to a hypothetical level of 10%. You can see spreads will alternate, they will widen, and they will narrow based on the net aggregate opinion of all market participants relative to the bull-bear tipping point and relative to the perception of future economic outcomes and default rates. And hence, credit spreads are basically determined by the laws of supply and demand. And the Fed does have some impact relative to rates, but at some point, just as Fed cuts become ineffective In the stock market, lower rates don't compensate investors for the added risk that they perceive, and regardless of what the Fed is doing with rates, spreads can widen. Let's go into the marketplace and illustrate one side of the equation using basic examples. Since ETFs haven't been around that long, we found a high-yield bond fund that has a high correlation with JNK, and we'll be using it as a proxy for the high-yield market. You can see here in the price of high-yield bonds concerns from market participants about the potential for increasing bond defaults when price falls here during the 1990 and 1991 recession. That recession officially ended in March. We can also see that some market participants looked forward and started to buy higher yielding bonds because they were convinced that future economic outcomes would improve. You can make an argument here there was accumulation in the high yield market in 1994, accumulation in 1996, and in both instances, good things happened after the period of consolidation. You can see the high yield market looking pretty confident here early in 1998. And that's when a noticeable and discernible shift started to take place. So now we've got the stock market or the S&P 500 on the top portion of our screen and high yield bonds on the bottom half. This is where the S&P 500 peaked in March of 2000. And this is where the divergence started to take place. The stock market prints a higher high in here. The high yield market, a discernible lower high. 1999, stock market, discernible higher high. High yield bonds, a discernible lower high. This is credit market participants starting to express concerns about the potential for rising default rates due to weaker economic outcomes in the future. And when the stock market peaked on this weekly chart in March of 2000 and made a higher high, high yield bonds nowhere near the high that was made back in 1998. The divergence can clearly be seen when we draw a line from this peak to this peak and from this peak to this peak. And if we move further out after the peak, the S&P 500 almost went up and made a new all-time high in August of 2000. Notice the stock market is trying to break out in a bullish manner. Conversely, over the same period, the high-yield bond market breaks down, potentially a sign of distribution. Things were still pretty good in the stock market on August 31st of 2000, but there was a massive divergence in place between the high-yield credit market and the stock market. The S&P 500 peaks here and then tries to make a higher high here in August. When this happens, there was a yellow flag in place for 26 months. Why a yellow flag? Because this is simply part of the weight of the evidence. There's nothing foolproof about anything in the financial markets, and that applies to credit spreads in the high yield market as well. After the yellow flag was waving for 26 months, what happened next in the stock market? From the end of August in 2000, or point A, the stock market lost an additional 48.82%. Do we have similar yellow flags waving in calendar year 2019? And have they been waving for several months? Once again, S&P 500 on the top of your screen, high yield bonds on the bottom of your screen. February 22nd, 2019, we have a bullish or positive divergence between the high yield market and the stock market. In this case, the high yield fund making a higher high here, and the S&P 500 has not yet printed a higher high. But this high here tells us to keep an open mind about the market eventually catching up with the credit markets and printing a higher high. No yellow flags in February of this year. On June 5th, a lot of fear in the market down here. S&P 500's nowhere near this high here. High yield fund printing a higher high. Once again, a positive or bullish divergence, which is radically different from the example we covered, an admittedly extreme example that we covered between 1998 and the peak in the stock market in 2000. This positive divergence told us to keep an open mind about new all-time highs in the S&P 500 on June 5th of this year. Those probabilities were helpful. The S&P 500 has printed a new all-time high. How about the peak in 2007? Were there yellow flags waving? The answer is yes, but they weren't waving as violently and obviously as they were between 1998 and 2000. June of 2007, the stock market right here where this line is makes a new high. This is a lower high here in the credit markets, and that divergence widened into July of 2007. S&P 500 prints a clear higher high, credit a clear and discernible lower high. Credit still waving some yellow flags at the peak in October of 2007. This is a higher high relative to this high in the stock market. This is a higher high relative to this high. This high here is higher than this high. Not so in the credit markets. This high here is discernibly lower than this high here. Positive slope with higher highs, negative slope and a divergence in place on October 9th, 2007. Thus, for over 4 months, the credit market was saying we better pay closer attention to risk here, and this helps us keep an open mind about worse than expected outcomes. What happened next from this point here, point A, in the S&P 500? The answer is really, really bad things, which is why maximum flexibility is always important, day by day. If we don't have a flexible, unbiased, and open mind here, could have been hit with a 56.78% loss between point A and point B. And as noted earlier with the term yellow flag, there's nothing magical about this fund here. We won't be watching it every day. There's nothing magical about JNK, the ETF. Nothing magical about the credit markets. They are simply part of the weight of the evidence. The weight of the evidence is very rarely 100% positive, and it's very rarely 100% negative. And we never make decisions based on one market or one data point. Also extremely important to emphasize, as always, we're using data to monitor and adjust our allocations if needed, which is radically different from forecasting, predicting, or making market calls. In late June of 2019, the credit markets look good. The stock market looks good. How long will that last? We have absolutely positively no idea, and we'll continue to take it day by day and monitor and adjust the probabilities if and when the data shifts, and we will also shift our allocations if needed. Another relevant question: what does present day supply and demand data tell us about the odds of a recession and the odds of a bear market, allowing us to show an anecdotal example of using data to monitor and adjust rather than forecast? With the benefit of hindsight, we know that many market participants were very, very concerned about a recession and bear market in late 2011 and in early 2012. The same thing can be said for 2015 and 2016, including markets that were very, very concerned and spooked by media reports of Armageddon if the Brexit referendum passed. Once again, in the present day, a lot of gloom and doom out there. Some of it absolutely positively warranted. There is no question that we have seen an erosion in economic data. If we look at the magnitude of the concerns in the present day about the economy, bond market, and stock market, are concerns higher today relative to 2015, 2016? Are concerns higher today about the economy, bond defaults, and the stock market relative to 2011 and 2012? To answer our question, we can look at credit spreads, which are determined by the law of supply and the law of demand, and the net aggregate opinion of all market participants related to all subjects on all time frames. The magnitude of concerns in 2011 were the highest relative to the three periods. In the present day, the magnitude of the concerns, the lowest relative to credit spreads, the peak in 2016 and the peak in 2011. It's very, very difficult to argue against that conclusion when we consider the fact that the reputations and capital of individuals, businesses, and banks are on the line relative to these type of decisions. And when money and reputations are on the line, I can assure you, Fed policy at some point will become ineffective. Given the look of this chart here, and given present-day spreads relative to concerning historical spreads, as of Friday, June 21st, 2019, it's very, very difficult to make the argument that we're on the right side of this curve in the credit markets, which tells us a lot about the probability of a recession and hence the probability of a devastating bear market. It tells us a lot about the probability of a triple top in the S&P 500. Credit spreads in late 2011 relative to credit spreads in June of 2019. It's extremely important that we take it day by day, respecting the fact that a spike in spreads is possible. We have to remain open to all outcomes. We covered this chart in the May 31st, 2019 video, and you may recall the equity markets were not doing particularly well on May 31st. This chart told us to keep an open mind about better than expected outcomes. The longer end of the curve, the more important end of the yield curve, has not inverted at this point, as we've covered numerous times. Nothing really new to report on June 20th, 2019. Inversion does not appear to be imminent. In fact, we're in a better spot today than at any time dating back to November of last year. Is there any logical reason to believe the fact that the 10-2 yield curve is not inverted yet is relevant in the present day? We've been very, very clear on our interpretation of the yield curve with a consistent message delivered on June 29th, 2018, December 8th, 2018, and March 29th of 2019. Sometimes it can be helpful to hear the same message from another source. Urban Carmel, Twitter handle here, where my cursor is. In the present day, we have seen 3-month, 10-year yield curve inversion. How significant is that historically, given the fact that we have not seen 10-2 inversion? Said another way, how many times in the past 40 years have we seen a recession rear its ugly head without first seeing 10-2 yield curve inversion? The answer from Urban, 0 times in the past 40 years, as in never. Not much has changed on the recession front. You can review it in the June 7th video. You can find it by Googling this title here. We've heard for months and months and months that the yield curve is inverted. It's much more accurate to say the yield curve is partially inverted. The long end of the curve, the more important part of the curve, is not inverted. This is where the recession risk shows up. This is where market participants make moves relative to two things: short-term volatility concerns and potential shifts in Fed policy. As we've covered numerous times, history says we should keep an open mind about the yield curve and Fed rate cuts. Some of these headlines date all the way back to 2017. The longer end of the curve has not inverted, which told us to keep an open mind about better than expected outcomes, and the S&P 500 just printed a new all-time high. But the long end of the curve is about to invert. Could have said the same thing in January of 1995. What happened next in the S&P 500? After the yield curve was about to invert, and it did not invert, the S&P tacked on 225%. How about the NASDAQ? After the yield curve was about to invert in 1995, but did not invert, the NASDAQ gained 568%. And as we've covered in the past, let's assume that the long end of the curve, the 10-2, inverted today. How concerning would that be? The long end of the curve inverted in 2006, 651 calendar days before the S&P 500 peaked in October of 2007. And in 1998, the long end of the curve finally inverted 668 calendar days before the major peak in the S&P 500. In those two anecdotal cases, after the first sign of 10-2 inversion, which we don't have in the present day, and it's not imminent, the average gain between the first sign of 10-2 inversion and the major stock market peak was 32.09%. Therefore, hypothetically, if the 10-2 part of the curve inverted today, the S&P 500 would peak, hypothetically, on April 11th, 2021 at a level of 3896. That's 1.83 years from today, and the S&P would be hypothetically 32% higher than it is today, telling us even if and when we get 10-2 inversion that we should still keep an open mind about better than expected outcomes in the equity markets. The yield curve is an early signal historically. You may have seen this headline this week: Philly Fed manufacturing tumbles. How concerning. Keep in mind, the manufacturing index is based on a survey. Here's the present day reading here, current activity index. We're making a higher low relative to the low that was made early in calendar year 2019. You can make an argument that this higher low is similar to this higher low. And the present day higher low is similar to this higher low. And we also had a higher low in the index in early 2009. You can also make an argument that we've come back to the zero line, similar to this point here where we came back to the zero line, and similar to this point here where we came back to the zero line. Respecting that there are some similarities between the present day and this period, and this period, how did the stock market do from this point here, this point here, this point here, and this point here, and this point here? The answer is much better than expected. 2 years out, average gain from a similar look in reading in the Philly Fed Manufacturing Index, 37%. The median gain Very similar, speaking to consistency for the most part, right around 40%. And all 5 of the cases saw the S&P 500 higher 2 years later. Simply telling us to keep an open mind about better than expected outcomes after the Philly Fed Manufacturing Index tumbled this week to a look that was similar to this look, this look, this look, this look, and this look. Also noteworthy here from MarketWatch. You may have seen this headline recently. Is this the biggest triple top in the stock market ever? Well, if you look closely here, this is a MarketWatch headline from January 30th, 2013. January 30th, 2013. We could have asked, is this the biggest triple top ever in the S&P 500? What happened next? The S&P 500 gained 41% rather than making a triple top. Also noteworthy, last week we covered the global Dow that's revisiting this area, this basic area, and this basic area, telling us to keep an open mind about better than expected outcomes from what may be a concerning looking chart. Also noteworthy, we outlined numerous reasons to be constructive on the global Dow, but we also pointed out last week that right now the trend clearly favors the S&P 500 in the United States relative to global stocks. That may change, but it hasn't changed yet. Quickly, let's cover some basic trend concepts. This is a monthly chart dating back to 1982. We can see that this is clearly a downtrend, and we have 100% normal and to be expected counter trend moves within the context of a primary downtrend. For the most part, price stays below a downward sloping 50-month moving average. Similar situation here in 2019. Thus, if we were taking a multiple choice test and we were asked, can you identify periods where you would prefer to be long and periods where you would prefer to be out of this market? From a trend perspective, pretty clear to say that we would prefer to be out of this market during this period here and out of this market during this period here, and we'd like to be in this market for the most part here. And similar to this period, the uptrend, the primary uptrend, has 100% normal and to be expected counter trend moves. At this point, the right side of this chart really hasn't proven a lot. It may prove something, but it hasn't yet. Can we learn anything from this chart? For us, and based on our time frame and our approach, the answer is yes. We're looking at the ratio of gold relative to the S&P 500. You can see gold killed stocks here, but lagged significantly here. In fact, between point A and point B, during a primary downtrend in the stock-gold ratio, gold between point A and point B lost roughly 30%, and the S&P 500 gained over 1,000%, telling us that jumping the gun on a chart like this can be extremely costly from an opportunity cost perspective. We are by no means down on gold or against owning gold. We just like to see a little bit more for our time frame and our strategy. That absolutely positively may happen, reinforcing the concept of keeping a flexible, unbiased, and open mind. Moral of the long story, we really haven't seen anything year to date that brings into question the research in 2019 that's been telling us to keep an open mind about better than expected outcomes in the equity market. As always, it's important that we head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.